Hello, and welcome to the Burken-Road Spring 2013 Research Report for Key Energy Services. My name is John Murphy, and along with my fellow teammates Sean Willis, Nick Curran, Na Jiang, and Yapu Zhu, as well as our investment research manager Larry Hall, I am proud to present to you our equity analysis for this stock under a rock. Our agenda for today will cover several topics. First, we will give a brief company profile for Key, followed by an industry overview and peer analysis. We will then break down Key's recent stock performance and provide backgrounds for the company's key management roles. We will conclude this presentation by providing our risk analysis for Key Energy Services, as well as our projections, valuation, and investment summary for the company. Key Energy Services is an oilfield service company headquartered in Houston, Texas. Key provides a full range of well services to oil and natural gas production companies of all sizes worldwide. The company currently concentrates its operations around four core business lines. Rig Services, the company's largest revenue generator, provides workover, well completion, specialty drilling, repair and maintenance, and plugging and abandonment services. Most rigs are equipped with the company's innovative KeyView technology, which is a real-time job data monitoring, recording, and reporting system that incorporates numerous safety and operating efficiency elements. The Fluid Management service line offers fluid disposal and transportation services, storage tank rentals, freshwater supplies, and total fluid logistic management services. The other two business lines that Key provides are its coiled tubing services and fishing and rental services. Coiled tubing services employs 46 coiled tubing units that provide completion services including wellbore cleanouts, millings, plug setting and retrievals, logging and perforating tool deployments, and remedial production treatments. The fishing and rental service line provides drill pipe tubing rental, pressure and flow control equipment rental, frac stacks and well testing, and pipe and downhole tool retrieval. As seen in the graph on the right, Rig Services represents 41% of Key's third quarter revenue. Fluid Management is the second largest business line at 17%. The fishing and rental and coiled tubing lines are the lowest revenue generators for Key, representing 11 and 13% respectively. As of 2013, Key has grown to become the largest land-based well services company in the United States, with more than 500 employees in the United States, plus an additional 2,600 internationally. Key Energy Services operates in most major producing areas in the United States, as well as internationally in Mexico, Colombia, the Middle East, and to a lesser extent, Russia. The company currently enjoys a $1.3 billion market capitalization and 151 million shares outstanding. The oilfield service industry encompasses a broad range of activities, from performing service-oriented jobs such as drilling or hydraulic fracturing to selling the raw materials and equipment required to produce, transport, and refine energy products. Many companies have increased their research and development programs in order to develop new products and technologies for the energy industry, such as 3D seismic, horizontal drilling, and hydraulic fracturing. Technology should be instrumental in the growth of the industry as companies look to increase their product offerings and differentiate themselves from the competition. There are many drivers that influence the oilfield services sector. Oilfield service companies rely heavily on the upstream, exploration, and production sector as the industry's main revenue driver. Due to budgetary restrictions, E&P company spending rose by only 4% in 2012, and activity transitioned from prime gas markets to oil markets, severely slowing the oilfield services industry. According to a survey from Barclays Research, North American E&P capital expenditures are expected to remain essentially flat in 2013, with an estimated growth of less than 1%. Because estimates predict only minimal growth in E&P capital spending this year, the oilfield services industry is expected to grow minimally as well. The dynamics of supply and demand for oil and gas represent another influence affecting the demand for oilfield services. Energy prices are dependent on the global supply and demand for the underlying commodity, which are impacted by worldwide economic and political activities. Instability in the oil-producing nations of the Middle East often disrupts the supply of crude oil coming out of the region, thus increasing oil prices. For example, the Organization of Petroleum Exporting Countries, or OPEC as more commonly referred to, is the governing body of mostly Middle Eastern oil-producing nations that collectively represent 55% of the oil traded internationally and 80% of the world's total crude reserves. This organization regularly sets supply levels for the world market in order to maximize revenues. Energy prices and production rates also affect the oilfield services industry. As oil and gas prices decrease, the incentive to drill diminishes since producers will more than likely realize lower profits because of the lower commodity prices. Therefore, production rates are likely to fall when oil and gas prices go down. Rig count reports, published weekly by several industry participants, are indicators of future oil and gas production activities. The table below illustrates the Porter's Five Forces for the oilfield service industry. Developed by Michael E. Porter, this model identifies and analyzes 5 competitive forces that shape every industry and helps determine an industry's weaknesses and strengths. The threat of new companies entering the oilfield service industry is low. There are several barriers to entry that prevent new firms from capturing market share. Operating in the oilfield service industry is extremely capital intensive, requiring a large inventory of heavy machinery and vehicles. In addition, most of the services provided by an oilfield service company require technical expertise. Consequently, highly skilled workers must be employed to perform jobs and operate equipment properly. Many oilfield service companies have also built business relationships with their customers. Therefore, experience and reputation will often attract business to existing market participants. Geographic scope is another barrier that can severely limit industry newcomers. With oil and gas activity located throughout many remote regions of the world, logistical challenges can arise for new entrants trying to operate in developing markets without much infrastructure. The bargaining power of E&P companies is high in the oilfield service industry. Many oilfield service companies have traditionally implemented a low-cost structure as their business models. Their intent is to provide products and services at the lowest cost possible to maximize profit. Since there are so many firms competing for market share, customers have many options when selecting a firm to do business with. Unless a solid business relationship has been established with a particular oilfield service company, energy companies often select the company with the lowest cost since most of the services, raw materials, and equipment an oilfield service provider offers are indistinguishable from other competitors. Although customers view oilfield service companies as being similar, there are some companies, such as Key, who have distinguished themselves by implementing proprietary technology into their products and services. As these technology-focused companies continue to diversify their business lines, E&P customers may be willing to pay for the value delivered, since the net benefits of using a company with more productive results will outweigh those of competitors. The availability of substitute products or services is low in the oilfield service industry. The products and services offered by this industry are highly specialized and cannot be easily imitated. Although a major energy company could integrate a well servicing operation into its business segments, it is highly unlikely due to the large capital commitment required. Most companies outsource their operations to oilfield service companies to capitalize on price competition and product and service flexibility. The bargaining power of suppliers is low in the oilfield service industry. Companies such as Key are not dependent on a singular, particular source for their supplies. Many of the companies that compete in the oilfield service industry purchase different raw materials that are not unique from one another. Therefore, companies can shop around for the best prices for these items. Key has an advantage in this area by manufacturing most of the company's rigs in-house. Key is able to customize equipment and tailor production to its own needs as well as its customers. Rivalry among existing competitors is strong in the oilfield services sector. Capital spending in the oil and gas E&P sector continues to be the main revenue driver for oilfield service companies. E&P capital expenditures largely depend on the market price or expected market price of crude oil and natural gas. If commodity prices are high, E&P companies generally increase capital spending and require more of the services oilfield service companies provide. The opposite is true when prices decrease. Oilfield services companies have to maintain a fleet of rigs and other equipment to remain competitive, regardless of the fluctuation in E&P capital spending. Along with the strong dependence on E&P capital spending, oilfield service companies must also compete against rival companies that oftentimes provide the same or similar services in the same geographic region. Pricing often becomes an essential factor when many companies compete for the same business. Many firms in the oilfield service sector are investing heavily in proprietary technologies to increase the accuracy, safety, and efficiency of the services offered. These companies believe that these investments will offer a competitive advantage over those companies that do not invest in these technologies. We chose to focus on Basic Energy Services, Superior Energy Services, and Nabors Industries to complete Key Energy Services peer analysis. These companies provide similar products and services, operate with similar business goals, and compete for business in many of the same regions. With a market capitalization of only $1.28 billion, Key Energy Services is much smaller than Superior Energy and Nabors Industries. Overall, Key Energy Services is very similar to its peers, but the company does have the highest price-to-earnings ratio and the second lowest leverage ratio among its peers.
Over the past 5 years, Key Energy Services has had large fluctuations in its stock price. Before the financial crisis towards the end of 2008, Key Energy Services stock price was as high as $19.31, before falling as low as $2.39 in March of 2009. Since that point, Key Energy Services steadily increased its stock price, reaching a 5-year high of $20.34 in July of 2011. 2012 and 2013 have proved to be more difficult periods for Key Energy Services, and the stock's 52-week range has fluctuated between $5.70 and $13.50. Key Energy Services is managed by a highly experienced team of oil and gas industry veterans. Dick Alario, chairman, president, and CEO of the company, has over 30 years of experience working in the oil field services and marine transportation industries. Trey Wilson III, executive vice president and COO, served as vice president of Forest Oil as well as a consultant for various other oil companies. Marshall Dodson, senior vice president and CFO, has served various finance and accounting roles at public energy companies for more than 20 years. Guillermo Capacho, senior vice president of international operations, global business development, and technology, has worked in upper management at Halliburton and is currently leading Key's expanding international operations. Additionally, Key has a board of directors that is comprised of members with a broad range of backgrounds and expertise to oversee the company's management. Return on investment, ROIC, is a common metric used to measure management effectiveness in allocating capital to profitable investments. ROIC is a ratio of the profit or loss of an investment relative to the amount invested. The current table shows the ROIC for Key relative to its peer group average: Basic Energy Services, Superior Energy Services, and Nabors. Key outperformed its peer average in 2010 with an ROIC of 7.49%. In 2011, Key outperformed its peer average again with an ROIC of 7.59%. In 2012, Key underperformed its peer group average with an ROIC of 0.06%.
Key Energy Services operates in an industry with many different types of internal and external risks. The operational, environmental, and financial risks that Key faces can affect the financial performance of the company and may cause negative shareholder value. Key's performance is heavily dependent on commodity prices. When supply exceeds demand for energy products, prices usually decline and the company's customers reduce their capital expenditures and wait for prices to increase. As a result, they do not require the services of oilfield service companies as much as when prices are higher. To operate efficiently, Key must maintain a workforce of highly skilled workers. Many oilfield service companies compete with each other to attract talented workers. Key must provide competitive compensation and benefits to its employees to attract and keep personnel. A shortage of highly skilled workers could result in the company's inability to perform its services and maintain profitability. Key is subject to various changes in laws based on safety and environmental regulations. The company continues to closely monitor federal acts controlling air emissions, global warming, and climate change. Key faces environmental risks associated with its fluid management segment in particular. As part of operations, the company routinely transports and disposes hazardous waste. In the event it experiences a spill, leak, or other contaminating accident, Key may become exposed to potential penalties and permit revocation. Key is also subject to internal and external financial risks associated with its financial health. These include liquidity, credit, interest rate, and exchange rate risks. To project out revenues for Key, we use a regression model for the first 2 years of projections and a steady growth rate thereafter. A regression model accounted namely for 2 different variables: total U.S. land-based rig count and a combination of PP&E, intangibles, and goodwill. Seasonality was also included as a variable because Key has historically realized lower revenues in the fourth quarter. Key's business volume is reflected in the amount of drilling activity the market demands. When the number of drilling rigs being used increases, the company is more likely to experience an uptick in business and realize higher earnings. Conversely, as rig counts decline, Key is more likely to see a fall in business activity, possibly leading to lower earnings. We made the assumption that total U.S. land-based rig count will remain relatively flat in 2013 in comparison to 2012 and increase slightly in 2014. To account for seasonality, our rig count estimates are higher in Q1 and Q2 and lower in Q3 and Q4. PP intangibles and goodwill is an adequate revenue predictor because the company generates revenue from the utilization of its fixed assets. As Key increases the size of its fixed assets, higher earnings are likely to follow because increased PP&E reflects a higher demand for the company's services. Intangibles and goodwill reflect any future acquisitions that would contribute to Key's higher earnings. Beyond 2014, we assigned a steady revenue growth rate of 6% in an effort to remain conservative. Because Key reports its earnings split between its domestic and international markets, we assigned a 80-20% split in 2013 for management guidance. Capital expenditures are the largest investing activity Key incurs. Management informed us that 2013 CapEx is expected to be $210 million. In order to project capital expenditures for 2014 to 2020, we took into account the company's CapEx to sales ratio from past periods to find a growth rate that fell in line with past performance. Given that we anticipate Key's earnings will increase significantly in the long run, we attributed a 10% growth rate in CapEx to support this rise in revenue. We have assumed that Key will extinguish all of its long-term debt listed in its 2012 10-K as scheduled during the 2013 to 2022 time period. We did not forecast anticipated borrowings in the future and have assumed that the company will pay off its debt and support its future growth with its incoming cash flow. We arrived at our 12-month target stock price of $10 by taking an average of price to book value, enterprise value to EBITDA, and enterprise value to sales multiples. We derived these prices from these methods partly by generating the same ratios for Key's peer group, which consists of Basic Energy Services, Superior Energy Services, and Nabors Industries. We evaluated Key Energy Services using other metrics, including a discounted free cash flow model, but did not feel these analyses were a good representation of Key's earning potential, as they were outliers to the methods used to value the company. The valuation generated a price to book value of $8.10, an enterprise value to EBITDA of $9.25, and an enterprise value to sales of $12.69. All three were weighted by 1/3 to generate our $10 target price. The table below illustrates the three valuation methods used to generate our target price. Our 12-month price target represents a 17% increase from Key's March 18, 2013 closing price of $8.53. Our $10 price target is in line with consistent estimates from many other analysts. E&P capital expenditures have historically driven oilfield service revenues. We expect E&P capital spending to remain relatively flat for 2013 and increase more rapidly in 2014 and 2015. Key's revenues should increase when the spending picks up. Rig services should remain Key's main income driver, but we do expect its other business lines to see growth. Even though we expect E&P spending to remain flat for 2013, we do think Key will see increases in revenue from focusing on increasing rig utilization rates and from added operational efficiencies. We believe that Key will continue to grow its international business and see a larger share of its total revenues come from international operations. Finally, based on our analysis, we give Key Energy Services a market perform rating and a 12-month price target of $10.